Good morning and a warm welcome to the Colliers webinar. We're delighted to say we've got a great panel today for our roundtable discussion. And I just want to introduce you to myself, Len Rosso, who heads up the industrial logistics team for Colliers in the UK. We also have Andrea Ferranti, our head of research, who will be doing a joint presentation on myself before the roundtable panel discussion. Over to you, Andrea.
Thank you very much, Len, for the introduction. So we witnessed to a quite extraordinary demand over the past 18 months. But now let's take a look at this in more details. So here I'm showing you the demand side of the equation. Q2 2021 take-up for units 100,000 square foot plus accelerated and posted 16.5 million square foot. This is actually 42% ahead year on year and a new record for the sector. This strong demand took the total for the first 6 months of the year to 24.8 million square foot, which is relatively in line with what we saw last year, which was a record here. So there is also quite a lot of space under offer or awaiting planning permission on the, and we actually expect this future expected demand to post a strong 2021. The pandemic has brought forward between 6 and 10 years of online commerce development in just over 1 year. And 2020 saw a record online commerce share of total retail sales. This share will inevitably decrease in 2021. However, consumer shopping habits have changed, and this will result in strong demand for online shopping. Looking forward, therefore, and based on our forecast, we expect supply chain to need an additional 50 million square foot of space to service this elevated commerce demand by 2024. But now let's take a look at take-up by quality type since 2014. So you can see how this has differed between occupier demand, standing stock, and development pipeline, which we'll come on to later in this presentation. This increased demand for speedy deliveries and also to a certain extent ECG requirements have continued to show in the statistics, as you can see here. This has meant occupiers have been expanding, in some instances consolidating their operation in more efficient warehouses. And for all the reasons that we mentioned here, new take-up has accounted for circa 75% recently, as you can see in H1 2021 and H1 2020. And this is a trend that we think will persist as new supply will come online, and also occupier requirement for design and build space will remain stable at around 45 to 50% of total take-up. But on these few points, I'd like to ask my knowledgeable colleague and market expert, Len Rosso, his opinion on this and how occupiers and landlords are faring in this competitive landscape. Len.
Thanks, Andrea. I think starting first with the occupiers, it's difficult times for them because we're obviously in a very buoyant market. Rents are going up on a monthly basis. Yields are compressing for record yields each time an investment is sold. And consequently, landlords and developers are generally, on the big box side, looking for leases minimum really 10 years in excess, ideally 15 or 20. That causes some issues for occupiers who are obviously looking to have slightly more flexible terms, particularly on the 3PL side, where ideally they're trying to back-to-back lease with the contract, so looking for shorter leases. That said, I do think with the high competitive nature of the investment market, that, I think landlords and developers could consider doing shorter leases rather than 10 or 15, where maybe the yield won't be impacted greatly. I think from the developers and landlords side, the challenges they're experiencing is actually trying to buy new kit, buy new sites. As I just mentioned, at the moment, yields are compressing all the time, making it very competitive for investors to buy on the investment side and also on the land side. Each time a prime site comes to the market, it goes well in excess of asking, and everyone keeps saying, well, we can't believe this is still happening. But I think the land values are going up in a higher percentage than even the rent. So I think these are the challenges for the occupiers and the landlords. Back to you, Andrea.
Thank you very much, Len. So today I feel a little bit more generous than usual. So over the next few slides, we are going to walk you through a detailed supply and spec pipeline analysis, which I'm sure you will find useful. So most of you are familiar with the low supply environment that the market is operating in, but how low it is, to be honest. So, well, we are at the lowest level on record with only 25.2 million square foot. And this also includes new spec schemes scheduled for completion in Q3 2021. So availability is down 26% year on year, which is again showing how tough the market is for occupiers. But if we analyze supply by size band, as shown in this table, you can clearly notice that all size bands have seen a significant decrease, with only the 200 to 299,000 square foot size band remaining stable. But the most depleted size band is the 100,000 to 199,000 square foot, which is usually the most in demand in terms of deals volume. So it'd be interesting to see how developers are reacting. So let's take a look at what has been delivered over the past few years and in H1 2021. So the market has seen an annual average total new supply of about 7.5 million square foot. But if we consider the level of occupier activity, H1 2021 saw very little being delivered across the board. Hence why we're also witnessing the supply crunch in the market. I should point out that quite a bit of space is being snapped up under construction or just little after completion. This is not really helping the market because, as you see, supply is at a record level low. But that is history now. Let's take a look at what the immediate future holds from a supply point of view. So developers and investors are trying to ramp up efforts driven by future expected rental growth and also strong activity. So here in these two tables, we are detailing what's either under construction or marketed for completion towards the end of 2021 and in 2022. Some of these schemes, of course, haven't started construction, but they will do so soon. That said, I'd like to highlight that quite a bit of space is actually being taken up, as I mentioned earlier. Therefore, based on our study, the market will not be oversupplied in 2022. These figures are pretty self-explanatory, Len. So I will pause here for a few seconds while asking you your take on it and what you think is going to happen over the next few months.
Thanks, Andrea. I mean, it's up there on the slides and stats, but I think, developers and landlords have done a pretty good job at spec for 2021 with circa 11 million square feet projected for the year. Out of that already, 5 million square feet is taken or pre-let. I think the other stat, which is quite interesting, is the spec completions for the half year for 2021 at 3.4 million square feet. And out of that 3.4 million square feet, already in excess of 2 million square feet is let or under offer. That obviously shows 60% is taking up, and it just sort of reinforces what Andrea and I have been talking about, the market with low volumes of availability and obviously high demand for high quality units. On that note, Andrea, I'll hand back to you.
Thank you very much, Len. So let's now take a look at what's happening from a rental growth perspective. So here what I'm showing you monthly rental growth for the industrial sector as reported by the MSCI. Should actually point out the monthly data tend to be more volatile. I usually say so because when you then look at the annual figures, performance seems to be a little bit lower than what we see here. However, this is the best tracker that we have to look at monthly rental growth. And as you can see, actually, rental growth has accelerated over the past 3 months, if not over the past 6 months, and across all the segments of the industrial and logistics sector. London, of course, outperforming with southeast, inner and outer southeast, and eastern side of England do extremely well. Standard industrial as a whole, UK, still posting a 0.5 rental growth on a monthly basis in May. With the rest of UK lagging a little bit behind, but this is to be expected because, of course, it's capturing a much larger sample in potentially not so primary location in some instances. Distribution warehouses doing really well with nearly 1% rental growth. But then again, this is history, and we expect rental growth to remain quite strong this year. As you've seen, supply is very, very low, and this rental growth will continue into 2021. It's going to be interesting to see how these new deliveries will affect the market. But at the moment, we don't see, as I mentioned, an oversupplied market. So what does it mean for our forecast for total returns? I usually show you our rental growth forecast, but I thought this time around I'll give you a higher level view in terms of total returns. So here with our forecasting team, we sat down, work up the numbers, tweak the model, and we're expecting the industrial and logistics sector doing really well, and with only supermarket outperforming slightly, as you can see from the figures. So over the next 5 years, annual average total return will do quite well, with standard industrial and distribution warehouses still continuing where they left off. This is going to be driven initially by rental growth and yield compression, again, with capital growth continuing. But then as we see capital growth normalizing into 2021, rental growth will pick up the slack and continue to result in good total return for the sector. This actually leads us nicely to our final slides before our roundtable discussion. So what's going on from a capital market point of view? So here on the left-hand side, I'm showing you investment volumes for the industrial sector as reported by Property Data and Colliers. We are looking at also upgrading these figures as we've cross-checked some deals. At the moment, 2021 looks extremely healthy, a new record half a year data of 6.3, 6.4 billion, as deals volume doesn't seem too slow. And this actually could potentially result in a new record activity, potentially going higher than 2017 when we've seen lots of corporate activity boosting the figures. So what does it mean for yield compression here? I've done a little bit more I should say, insightful analysis here by looking at the lower quartile from an MSCI, hence reflecting the prime end of the market, looking at both net initial yield and equivalent yield, so accounting for reversionary potentials. As you can see, we are at record low, and we continue to see some strong pressure, 3.5% net initial yield at the national level, as reported by the MSCI sample, while equivalent yield is actually at about 4.3%. But I wouldn't be surprised if we touch 4% over the next 6 months or so. So there is still a lot of competition, a lot of buyers chasing limited opportunities, and yields are really keen due to also a low financing rate and other sector not performing as usually, particularly pre-pandemic. So Len, before again we open up to the roundtable discussion, what have you seen in the market over the past 6 months, and what you expect to see over the next 6 months to 12 months?
Thanks, Andrea. I think from our in-house perspective over the next 12 months, we still believe yields will compress further. How much, that's debatable, but believe they will compress further over the next 12 months. With regards to looking back slightly or currently in the market, we've been involved in a number of high-profile acquisitions for occupiers across the UK, all in excess of 500,000 square feet, where those investments were actually brought forward on a forward funding basis. Each time those projects which were brought forward on a forward funding, we weren't involved in the investment side, but obviously we acquired them. They went for between 25 to 100 basis points better than quoting. And I think anything which is prime with a good lease and a good covenant in a good location will actually go substantially better than quoting at the moment. Just finishing, I think from the yield perspective, we do believe they will compress over the next 12 months. Back to you, Andrea.
Thank you very much, Len. And so this presentation will come to close. And thank you again, Len, for your assistance on this. So I'll hand you back to you actually to introduce the roundtable discussion and our guest panelist, our Colliers panelist. Thank you very much.
Thank you, Andrea. We obviously have our roundtable panel discussion today. Firstly, I'd like to show on the screen our panelists for today. I would like them to introduce themselves. If we start with Richard.
Oh yes, good morning everybody. Richard Webb, one of the founding directors of Webb. We are a project management company and cost consultancy, particularly specialising in the industrial and logistics sector, and generally we act for occupiers, developers, investors, agents and funds.
Thank you, Richard. Steve?
Yeah, morning everybody. Steve Ellis, Associate Director for Infrastructure and Health and Safety for DPD UK Group. You all know who we are. We're a massive e-commerce B2C, B2B player in the parcel business, and we're looking for big buildings. So I'd be happy to discuss this further. Thank you.
Thank you, Steve. Georgia?
Thanks, Len. Morning, everybody. Georgia Pirbhai, work in the industrial and logistics team in the southeast for Colliers, working on the landlord and occupier side. So I see both sides of the coin.
Thanks, Georgia. Simon?
Thanks, Len. Hi, everybody. Yeah, Simon Norton. So been with Colliers for 19 years, one of the directors in the Birmingham team, so covering the West Midlands and East Midlands market. And again, acting on both sides, so for occupiers and landlords and investors on the industrial and logistics sector.
Thanks, Simon. Rob?
Thanks, Len. Morning, everybody. I'm Simon's younger counterpart, covering the Yorkshire and the North East on the occupational agency side.
Thanks, Rob. Right, let's get into it. Introduction. Our first question to the panel is going to be about the low supply and strong demand. Obviously, this is fueled by the boom in the e-commerce, which has led to very low supply of warehousing stock. We feel this is likely to continue. And off the back of that, our first question, if we put to you, Steve, from an occupier's perspective, how is the lack of stock impacting the market and your day-to-day sort of strategy on when you're looking at accommodation?
Yeah, it's a good question. Thanks for that. It's very difficult at the moment. As we're trying to grow year on year as a business, with the pandemic hitting us last year, we've grown substantially. We had to take on a lot of buildings, a lot smaller than what we wanted to do, just to keep up with the demand of the business. That's left us in a position now where we need to start consolidating back. So we've got around about 90 sites in the UK, plus we've got some strategic sites in the Midlands, both east and west, which are our main hubs. But what we need to do now is protect those hubs by going bigger on our depots, consolidating and bringing that 90 plus down to around about 60 or 66. So the difficulty for us now is to find the right size building, the right location. And to try and develop speculative build, it takes anything up to 4 years. So to try and get existing buildings is very difficult for us. We don't have enough yard space. There's probably not enough doors to operate the way we'd like to. So any opportunity to find existing buildings, we would look anywhere in the country. London's probably the most difficult at the moment. Other parts of the country, less difficult, but the demand is so high now that like you say, the rent and everything that goes with it is just going through the roof. So it's difficult at the moment.
Steve, thank you. And is there a sort of particular size for the Southeast depots for our audience, which you're particularly looking at, which come to mind, or does it vary from location to location, or is there a sort of stock, sort of standard type of facility you would make do with?
Yeah, again, it does vary. The size of the building, we would look around 100 to 200,000 square foot, but we're a bit different to other people. We want a building with lots of yard. We need lots of opportunity to park trailers, which coincides with our operating license. So if we want a 100,000 square foot building and we want to put 100,000 parcels through there, we have to show that we can park about 80 trailers. So there's not many opportunities to find a building of that size and that amount of parking at the same time. So we're then having to look at alternative parking off-site away from the building, which is not ideal.
Thank you, Steve. And the same question to Georgia, but from an agency perspective, assuming we're sort of seeing similar trends to what Steve is, Georgia, but I'll let you answer that.
Yeah, exactly, Len. I think we kind of echo Steve's comments from the agency side. We're seeing a lot of clients either re-gearing leases to buy themselves some time and rejig their supply chain, or we're being asked to kind of engage earlier by our occupier clients to secure perhaps D&B opportunities, or certainly pre-let opportunities, to kind of try and beat the market where we can.
Thanks, Georgia. Let's try another question. We'll come to you again on this, Steve. Sorry, the first few are sort of all directed at you, but really keen to get an occupier's perspective. How has your strategy changed or adapted over the last 12 months to allow for the lack of supply? You sort of touched on it, that you may be looking at existing buildings not ideal, and you've taken some, but now you really want to consolidate. What are you doing? Are you taking some buildings which don't fit your requirements ideally, but because there's nothing else, you're making do with that? Steve?
Yeah, exactly that. Last year we took on an additional 16 sites, which was not in the plan, and each site did around 20,000 parcels. So it was enough to grow the business where we needed to last year. But because they're not ideal sites, we have to do lots of compromises. We usually around the 5-year lease for a site like that. Purpose-built sites for us will do a 20 or 25-year lease. Existing buildings, usually around the 10 or 15 years, which is what most people want. But now we're going to be left with a lot of these small sites that we need to sublet or leave empty once we can move into the bigger sites and consolidate.
Excellent. Thanks, Steve. Just another question, a little bit off piste. One of the new sort of new use classes is Class E, which is for out-of-town retail premises, and I think it can be used for other retail premises. George, I know you've been involved in a few projects like this. Maybe you could talk very quickly about that.
Yeah, absolutely. I think the creation of Use Class E was designed in part to help the struggling high streets, and also to kind of rebalance the retail accommodation that was no longer needed as we've moved to a world of e-commerce. I think it was highly publicized, and it was kind of built to be a bit of a game changer, but it's heavily caveated by the fact that you can't change the use purely to industrial unless you can prove that it's not detrimental to the surrounding areas. So unless you can, we haven't seen a mass exodus of core industrial occupiers from industrial space into the high street. It's not that clear cut, and the planners aren't that on board with it. However, we are seeing kind of new concepts such as the dark stores and dark kitchens, which are kind of creeping into that space, kind of a blend between industrial and retail.
Thanks, Georgia. I'm assuming that's because their location, they're in very sort of high profile locations, and that's why they work for these dark kitchens and similar things. Exactly, yeah. So they're totally driven by demographics and the need to be very, very close to their customers. So high streets are the obvious solution for them, and that's why they're kind of reaching into that space. Thanks, George. Just before we move on to the next topic, does any of the other panelists have any other thoughts on that? Okay. The next topic, which is obviously we sort of touched on already in our presentation, is land values and rents. And what we're going to do is come to Rob in the first instance on this question. But how much have land values gone up, Rob? And what are you seeing in the market with regards to these land values and new entrants to the market? Is it literally the person with the deepest pockets is winning these sites? Or are there some other skills to it with pre-lets, etc.? Rob?
Thanks, Len. Yeah, you touched on it earlier. I mean, land values per se, I would say they have doubled plus over the last, certainly over the last 5 years, but that big fastest acceleration has probably been over the last 18 months or so. There's a ferocious appetite from developers and funds to get hold of these sites, and obviously that's driven the values forward greatly. I mean, some of the development appraisals that that I've run myself when we've been trying to bid on sites. We've been pushing things on the rental front because, as Andrea touched on earlier, there has been great rental evidence in terms of the growth, and we only forecast that that's continue. Obviously, the investment market has been extremely strong with appetite for products. So yields have been pushed to, you know, sub 4% on some of the development appraisals, and like you touched on, we see that aggressive pursuance of the income only continuing. So we don't see yields falling away, but because there's no stock as well, that's driving rents on even further. The occupiers are in a competitive situation, which is going to lead to further rental growth. So all in all, that is basically driving on the land values. I think.
What sort of yields are you seeing on these appraisals when they are on the land values? I'm assuming they've got to be around 4% or a little bit below that to actually win a site at the moment, because everyone's being so competitive on it. Have you seen anything in the low threes, mid threes in your part of the world?
So mid threes was the last conversation I had, which was yesterday, and that was on a site of circa 27 acres in Leeds.
Wow. Okay.
So extremely punchy.
Thank you, Rob.
And I'm sure Rich will probably touch on it as well. But you know, I think we're probably comfortable in terms of the rental growth. We're probably comfortable in terms of where yields are, because there's evidence there for both. I think probably where the uncertainty is at the moment is probably on tying down an accurate build cost. Because I mean, Rich will probably touch about that later on, but how do you fix up a firm build price at the moment? And a committed delivery timeline as well.
Yeah.
But I'll be quiet now.
Thanks, Rob. Simon, what are you seeing in your part of the world?
Yeah, I mean, it echoes very much what Rob's saying. Weight of money across all sectors, all sorts of vehicles. So sort of joint ventures, collaborative approach from sort of funds with development managers, or direct investment from investors. But we're also, I think, globally seeing everyone just look into the UK in the logistics and industrial market and go, we need to get a part of that. We want some action within that sector, because it's the golden sector at the moment. It's like, you know, you've got the golden ticket. The issue there is then from an occupier's point of view, and Rob's already touched on it, is the timing, delivery, program, and cost. And generally, a lot of the time from an occupier's point of view, when we're doing occupier work, you know, we try and get in as early as possible. That needs to come forward even further because the programs have been extended. From an occupier's point of view, the issue that they face is that if it's a back-to-back contract that they're trying to tie down, their customer can't sign. So you get all these roadblocks that need to be managed, and obviously that's where hopefully we can add some value. But yeah, generally in the Midlands, we've probably seen rents move on 25 to 50p per square foot in the last 3 to 6 months. You know, deals are being achieved at that level, and then people who are bringing schemes forward for delivery of back end of this year, stroke 2022, sort of keep the powder dry, because no one really knows what's going on with the supply chain. So it's it's a big puzzle, big Rubik's cube. People are trying to solve the answers, and ultimately it comes down to, a lot of it is down to the raw materials and the supply chain.
Thanks, Simon. And just one, are you seeing that when you say globally sort of coming in occupiers, is that from Asia, or is that from the US, or a combination of both?
I think it's a combination of both. I think from the straightforward property investment point of view, the US funds and US vehicles are heavily targeting the UK. I think from an occupier's point of view, yes, we're seeing a lot of activity come from the Far East, and I think we'll see a lot more in the future.
Okay, thank you, Simon. Rob, I see you put your hand up. Did you have something else to add there before?
Yeah, I think another factor that's becoming more prevalent is the end users actually looking to self-deliver as well, and having the firepower to acquire sites themselves. They know what their exit point is in terms of the value of their covenants, So obviously they can look to absolutely de-risk it, and hence push up the price that they can afford to pay.
Right. Thanks, Rob. Our next question is sort of, we sort of touched on already, but this is for Steve and Richard. How is this impacting the rents and the site selection for you guys? We'll start with you on that, Steve. Is it literally just got to sort of suck it up and sort of go with it, even though the rents, as we said, are moving generally on a monthly basis? Steve?
Yeah, it's a good valid point. In parts of London, it's take it or leave it situation. Other parts of the country, you've got a bit more negotiation power to say you're not prepared to go up as high as that. We are seeing rental prices in certain parts of London going really high, places like Mitcham, for example. But it is one of those, if you're desperate enough for the location to grow the business, which most people know you are, then you have to pay it, or you take the risk of not delivering and being a long way from where you need to be, which in terms makes less money. So there's no choice sometimes.
Okay, thanks, Steve. I know this. If I could ask the same question, Richard, I know it's not ideally a forte on the agency side, Richard, but it'd be good to get your view on that when you are speaking with your occupiers, or actually even the developer clients of yours. You know, are they firstly on the developer side looking to push their appraisals and what they're adding in maybe from a welfare side, and then on the occupational side, is that something we'll come on to sustainability shortly, but are they looking for you to really negotiate hard on the costing side when you are involved, Richard?
Yeah, I mean, effectively, the problem we've all got, and we can all see at the moment, is the commodity prices and construction costs. So that's having a huge impact in respect of what our development colleagues are putting in their appraisals as well. And I think, you know, Robert and Simon touched on this earlier, that it's what that number actually looks like, and then what the impact is on both land price and rental value, really. So it's a real conundrum at the moment, Len, and it's something that, you know, we've been working very hard on for the last, you know, 3, 4, 5 months or so. A difficult question to answer.
I thought I'd just try. We've got a few more questions for you, Richard, but obviously I thought we'd try you on that one. Okay, let's move on to the next topic, which is basically construction and materials. I think the first thing is obviously because of COVID and basically Brexit, we've seen a number of issues talked about within the market. And one of those is, how is the lack of supply and increase in the cost impacting the ability to stay on schedule with build or spec? And Richard, this is for you from both sides. So initially, I suppose, on the developer side, how are they finding getting the materials in? And then on the occupier side, how are they finding it? Sort of, is their facility built on time, or is there constant delays? So maybe if I could throw that one out to you, Richard.
Of course, yeah, no problem then. Thank you. I mean, effectively, the ability to sort of turn a site quickly and to develop it and to push a construction program is kind of a distant memory, a very enjoyable distant memory as well. With the shortage of cladding and steel and the commodities at the moment, we are seeing, for example, a cladding lead-in periods for certain types of cladding at 52-week lead-in period. So you can imagine that if you've got a construction project at 38, 42 weeks, you've got to be ordering your cladding well in advance of that. So the issue for that really, and it really kind of pushes both into appraisals, but also for the occupiers, is that the buildings are just we're not able to achieve the programs that we were previously. So, you know, we're talking about lead-in periods depending on the site complexity. If it's a greenfield site, you could have a lead-in period of say 6 months just to pre-order your cladding and steel. And obviously that's got a huge impact at the moment, Len. It's something that's pretty much unprecedented at the moment.
And obviously you navigate both sides of the coin, as it were, Richard, on the occupier and developer side,
Yeah.
is generally where you've been involved, it's come to a sort of amicable agreement, or is it literally, you know, we understand that, but from the occupier side, we still need it delivered because obviously we generally got leases expiring, etc., etc.
Yeah.
Or is there a sort of an awareness from the occupier because of you advising them that there are issues with this? So to expect some delays because of this. It'd be interesting to hear your thoughts from that side of it, and then I'll hand over to Steve to see what he thinks. But
no, effectively there wasn't an awareness, but I think it's becoming a reality with the occupiers. So the occupiers that we're speaking to are now well rehearsed, I think, in respect of the current situation with the both the you know, the stresses on the program, but also on the build costs as well. Main contractors are generally picking and choosing their sites at the moment. So, you know, to try and actually get the procurement process underway is also a bit of a stress for both, you know, developers and end users, really. So yeah, it's we've certainly seen a sea change in respect of where the occupiers are coming from, and also with the developers as well. It's, you know, it's hard for them to actually, in an agreement for lease situation, actually pin down a target date. So again, there's a realization, but there's more flexibility in the market that we can see at the moment in respect of actually delivering a project.
Thanks, Richard. $1 million question though. When do you think is going to unlock itself, this? Can you give a view on that, or is it just sort of stargazing? Well,
it's a little bit of stargazing. You're absolutely right, and it changes on a weekly basis. So, you know, good few weeks ago, sort of mid-June, we were thinking that, you know, surely this has got to come to an end, and that the stresses on the market will, by the end of this current year, would start to relax. We are hearing that, you know, into 2022, we've still got price increases and you know, such high demand with such low supply that we're still going to be seeing this into at least mid-2022. But again, it's a moving target. It really is.
And Richard, just finally, before we hand over to Steve on this question, let's say for, you know, a mid-box, large shed, you're talking, let's say, broadly, I'm not saying right because I don't profess to be an expert on it, but just from some of the players I have seen over the last year or so, broadly for a cross stock, the ones I've seen prior to the sort of delays, they've been around sort of £55 a square foot for, you know, a good quality sort of, I would say very good sort of cross dock facility, or BREEAM rating. What do you think the construction costs overall have gone up by? 5%, 10% in your experience?
So since December 2020 to kind of now, effectively July 21, we've seen anything, depending on the site configuration, size of unit, etc., yard sizes that Steve was touching on earlier, anything from 10 to 15% increase in 6 months. Wow. Which we've just never seen that. You know, I've been in the industry 25 years plus, and not seen that as yet. You know, that's just completely unprecedented.
Yeah, I mean, obviously, I suppose from developers' perspective, that could be their profit, couldn't it? Sort
absolutely.
Of, you know, when you're looking at some of these sort of being so competitive by the sites.
Yeah,
Richard,
absolutely.
that's excellent. Thank you.
No problem.
Steve, just a sort of variation on that. Because of these sort of delays on the construction sites, you know, how are DPD dealing with this? Are you taking the view that actually you're sort of trying to work with the developers, or are you pushing back and saying, well, we signed an agreement for lease for this to be developed on this date, on this time, and you're sort of banging your fists on the table, or are you taking a slightly more pragmatic view?
Exactly that. We are being a bit more relaxed than we would normally. We would normally have a very strict blockade period in the terms, where we wouldn't take the building at a certain time of the year because it was no use to us. It was because we would have to, once we've taken the building, we'd have to then do our own fit out. Our own fit out is automated conveyor systems which handles the parcels. What we're seeing now is the lead time for the automation is around 14 months. So we're having to place orders for equipment for the buildings before we even agree the heads of terms. which is a big worry for the board. It's a big risk, big investment before you've even got a building or even a PC date. So we are being more relaxed. Some of the existing buildings that we're taking on now, there could be around 6 months work for us to do in terms of putting extra doors in, making it fit for our purpose before we then go and put our own conveyor systems in. So we're also taking on buildings that may stay empty for anything up to 12 months or more before we even start operating, which is also a big cost, which nobody wants.
No, I can understand that. So going forward then, from your perspective, an occupier's perspective, you are being more pragmatic. You've accepted as these delays out there. And are the developers, when they're trying to sort of do a deal with you, is COVID clauses the standard now, where you're getting it in there, they can't get the materials? It wouldn't be the old sort of liquidated damages. It would just be an accepted delay because of COVID. Are you guys generally accepting those types of clauses going forward, or is it still each case by its own negotiation?
It's case by case negotiation, but you're finding that everyone's trying to put that COVID piece in there to cover themselves as well. But because we have been more relaxed on the blockade, people tend to be a bit more relaxed on putting the COVID in, knowing that they're also not going to incur any penalties themselves. So it's a two-way thing.
Yeah. Thanks, Steve. I think just before I move on, is there any other sort of the panelists who have anything to say before we move on to the next topic, which is the labour shortages? Okay, let's move on to the labour shortages. Due to obviously Brexit and COVID, labour is becoming, good labour is obviously a real topical subject with our occupiers who we advise, and becoming more and more important. And, you know, from that perspective, maybe in the first instance, I can throw that out to you, Steve, to see what you think on the labour pool. Is it your major priority now when you're choosing a location, or is it actually location to your sort of supply chain across the UK where you've got the gaps?
Yeah, we use a software system, and what we do is we put the full to earth postcodes in there that we need to deliver in that area, and it gives us a postcode range of about 15 locations. We go and look at those locations, but because it's a piece of software, location number 1 could be the city centre. It doesn't know where the land's available. So we would take them postcode ranges, we're going to find the best areas within that area to look at building, but then we also look at STEM mileage, we look at recruitment, and recruitment is in the top 3 now. So it's location, STEM mileage and recruitment, especially with the shortage of drivers as well, which is a well-known issue across the whole country at the moment.
Thanks, Steve. Maybe a slightly different spin on that, Richard, if I come to you, is from a labour perspective on the construction side, is it getting more and more difficult to get good labour for the construction because of Brexit, COVID, or are you finding most developers and funds are dealing with this pretty well?
We've got a bit of a perfect storm at the moment, Len, in respects of the commodity prices, low supply, high demand, but that is also impacting on the labour market. So to use cladding again as another example, I think what we've got to be really careful of is that with the cladding market generally and steel market as well, the labour forces are getting very stretched. And my concern on that is that not only we're not able to actually physically construct and provide end product, but also the quality of that product as well, which could also be impacted. So we're very mindful of that in respect of trying to lobby the supply chain as much as we can. But yeah, labour is definitely it's a shortage, certainly on specialist labour, and that has been impacted by the Brexit situation.
Thanks, Richard. Georgia, why don't we come over to you from an agency perspective? Are we seeing this in many of the transactions we're involved in?
Yeah, I think echo kind of Richard's comments really. Obviously the first issue when we speak to developer clients is sourcing the materials and remaining on track for the build programme. But the longer term issue is definitely labour, and whilst we anticipate that the building materials issue will resolve itself, we hope in the next 12, 18, 24 months, there's a much longer term issue at play when it comes to labour. So there's a lot of head scratching going on about how we correct that issue.
Thanks, Georgia. Back to you, Steve, and one question. Obviously, on the labour pool, it is, as you said, it has been tricky. And you've said how you do your site selection. Are you finding that if you go to a big logistics park or a site where are other occupiers on there, are you finding you have to pay more for your labour pool, or are there some occupiers who, if they're on a site, you may stay away from because obviously they're constantly taking further labour, or is it a case-by-case thing, Steve?
We generally pay very well in the market. If we need to pay higher, we will. We do offer a lot of good facilities for all of our employees, so we attract them not just on the hourly rate, which is always the key thing. People want to work, but it is a case by case. For example, Magna Park in the Hinckley area, you wouldn't go too close to that because the competition for drivers is just, you know, it's huge. So wherever possible, if you've got the opportunity to be a little bit further away from the big industrial retail parks as well, then it's much better for us.
Thanks, Steve. And I must ask, I know it's something you must hear every year. We're only in June, but obviously Christmas is only 6 months away. Are you concerned about your supply chain, be able to cope with obviously a huge amount of deliveries coming up at Christmas as everyone orders so much more online now, Steve?
Yeah, we are concerned. We've got a lot of plans in place, and we will be able to get through the site. Cyber is usually bigger than Christmas, so Cyber Weekend, Black Friday, Cyber Monday, they're always bigger or just as big as week 50, week 51. We've got a lot of plans in place. The biggest issue we have at the moment is trying to purchase enough electric vehicles to grow our green strategy, which we're struggling to get as many as we'd like to because we want to accelerate that. But I'm sure we'll be okay this year, but it's going to be touch and go.
Thanks, Steve. We sort of touched on it from an agency perspective, but maybe just ask one or two of my colleagues, what are the sort of hotspots for labour pools in your part of the world?
Thanks, Len. Well, it's always a bit of a funny question, is this, because obviously in terms of your traditional logistics hotspots, it's been those that are close to the key transport links and the chimney pots. However, because of that sort of demand nature of those locations, they do attract the occupiers, and they have the critical mass there already. And it goes back to what Stephen mentioned earlier on about, you know, you then go into a location where there is standing competition. So we've had a number of occupier clients that have said they won't go in close proximity to a certain occupier because of the difficulties in getting staff. Now, I think as the world has moved on, certainly over the last 2 years, that named occupier that our party didn't want to go next to, they are pretty much everywhere across the UK. So it's something you can't get away from. However, you know, I think chimney pots and labour is a very key driver in all the occupiers' minds. And I think what we'll find moving forward is the hotspots are done. They're exactly that, they're hotspots. But where you have large tranches of land with a good supply of residential and the motorway networks that might not have been your prime 5 years ago, I think those sites will be looked at in a lot more detail by occupiers now. So, you know, the traditional northeast, Doncaster still has a vast array of both land and employment. And I think other things that developers are bringing into play are trying to assist with the occupiers in terms of employment engagement. So the iPort Academy, for example, that Verdian and Business Doncaster have set up, that's a prime example of trying to bring the local population in and really upskill them.
Yeah. Thanks, Rob. I suppose just one thing maybe, Simon, I can ask you about, because I know you're very hot on this. What about amenities for the occupiers when we're advising customers on their acquisitions? Is that something, because, you know, I see it in a lot of the buildings, some of the logistics facilities now have amazing facilities, you know, terrace for the employees, gyms, you know, some areas even have sort of yards for walking their pets. They have a day for bring your pet in. Are you seeing this as more of a, I know it's just a small side of it, Simon, but are you seeing this more and more on our big occupier acquisitions?
Yeah, very much so. I think it's on both sides. I mean, Steve touched on it. Because we all spend so much time at work, and it's attracting the right staff to do the right job. It's not a case of just moving boxes anymore. You know, logistics is a career. So, and to make that time at work more enjoyable, you have to put the softer pieces in. So a gym, you know, an area for walking, all the big new developments that are coming through by all the big guys, Prologis, IM, Goodman, etc. They're all considering outside areas, walking trails, fitness trails, and then also, as you say, in buildings, gyms, etc. It's about quality of life and attracting the right people. But I think upscaling broadly, you know, we talk about sheds, but it's a very complicated sector that we now operate in, and it's very important for the UK economy and the world economy in terms of what it provides for consumers.
Thanks. I mean, Georgia, I just see you got your hand up.
Yeah, I think I'm just going to echo Simon's comments. It kind of feeds into that wider ESG corporate responsibility piece. And I think just from my own experience and the large requirements that I'm working on, the key decision makers at the client's end now all include the head of HR or personnel. So it is being taken very seriously at kind of C-suite level.
Thanks, Georgia. Right, we move on to the next topic, which is parking, which I know is very sensitive. Steve's touched on it already. And I'm assuming I'm going to ask this question. I think I know the answer before you answer it, Steve. But are you seeing an increase in demand for parking sites? And how are developers getting around this to accommodate DPD? Steve?
Yeah, there is a huge demand for parking. The big issue we have is the amount of van drivers we have at a site. So a typical site would have around 300 routes, so 300 van drivers. Now, we have to be careful we don't start congesting up the estate, because there's not enough parking on the actual the site that we own, that they start parking off-site and causing issues there. So we do need sites that we open with bigger parking facilities. 350 van plus is sort of what we're looking for now, and 80 to 150 trailer parking. That is ideal for us. Alternatively, if we can't get that, then we need to look at alternative areas where we can park, which is within close proximity of the sites.
Steve, is deck car parking a sort of a suitable or an alternative for the vans, or can they just not provide a decent deck car park for the sort of slightly larger vans rather than the domestic cars? Is that, I've seen on a couple of the occupiers where they've done some multi-story deck car parks, and they looked, you know, quite trendy, if I'm being honest. They've got some sort of nice sort of facade, and even though it is sort of quite visually, you of course see it on the landscape, I think they are a nice sort of addition to it rather than just seeing the vans parked there. I mean, is that some of the solutions you've been offered, and does that work for DPD?
It does work, yeah. We've actually looked at some multi-story car parking for the vans. What we try and do now is bring the vans in waves. So rather than all the vans trying to come onto site at one time, they'll come in waves, and then the remainder of the vans will stay in the car park. Multi-story would work for us. I've not seen a multi-story trailer park yet, which I'd be interested in seeing if anyone's done that. But yeah, definitely be interested. Thanks,
Steve. Richard, just must ask you, because obviously you do advise a number of key occupiers on this, and parking is obviously an issue. How is it your experience? Is it with the multi-story car parking? And I've seen some good examples where developers, I think, have done a really great job on this. Is that the only solution, or are there other ways to mitigate the parking issues, Richard?
What we've seen and what we've kind of we've kind of instigated on a few projects is actually to have the cars on the multi-story car park deck that then gives better density in respect of actual yard area for vans and HGVs. So that's one way of achieving it, because that's a slightly easier and cheaper alternative to create more space in the external areas. But then we've also looked at kind of mitigating things with as Steve was saying, with more local areas for car parking, etc. as well, and kind of almost busing people in or bringing people in buses to again create more area on site for the HGVs and also the vans. So yeah, there's kind of trying to think outside the box a little bit as well.
Richard, and I know it's not your area of sort of expertise on the planning side, but you're obviously involved in a lot of these meetings. Is it still the planners are very against for the additional parking and these types of things? Because it always seems to be, whenever I've been involved in a project, and it's not unreasonable to have more vans, because the way everything operates now, it's different to what it was 5-10 years ago. Yeah. Your experience on the developer side and the occupier, is there still quite a lot of pushback from the planners when you're involved in these big projects?
Not as much as there used to be. I think it's slowly dripping through in respect of the, obviously what they're concerned about is any impact on the local network, on the local sort of road network. And I think, there's been a fair amount of studies by both developers and occupiers in respect of actually providing data to alleviate the planners' concerns. So definitely, we're not there yet. There's arguments from planners or discussions to be had, but certainly we are seeing a step change in that and the attitude to that as well. Right.
Thank you, Richard. I mean, we only have time for one more question. We almost got through them all, but not quite. So I'm going to pick the sustainability and ESG. How is this driving the decision making? Has sustainability now become a requirement for a funding and operational perspective, or is it something which is still driven by the occupiers? And I'm going to ask you first that question, Steve.
Yeah, we've got a very strong opinion on sustainability and green strategy. We're in the process of doing what we call 25-25-25, and that's to deliver to 25 cities by 2025 on all green or alternative use vehicles. So it is huge for us. The difficulty we have is the power requirements at sites. Most of these sites are restricted on what they can give you as a kVA, for example. So because we can't install then 300 fast chargers for the vans, we then can't offer charging on site because we can't pick and choose who can and can't use them. So we may have 1 or 2 fast chargers for emergency reasons, in case someone's had a power cut during the evening and they've woke up and their van is flat, or they've just about got enough battery to get to site, and then we can use these fast chargers emergency. So we have to then team up with people like Shell and PodPoint and BP and offer all these alternative locations. We've got about 15,000 locations at the moment around the country where people can go and charge their vehicles. But it is something that we need to heavily invest in and look at for the future.
Thanks, Steve. And Richard, I think finish off with yourself. From a developer side now, I've heard it from the occupier side. Yep. Is it equally as important, the sustainable and the green credentials of a building from the developers? Traditionally, it has been the occupiers, but I've seen a real sort of a sea shift over the last 3 years, where developers seem to be as equally on this as the occupiers now.
Agreed. I think most developers now are very much attuned to the whole green agenda. So yeah, the guidance and the approach by UK Green Building Council is kind of the general approach that developers are now taking. And the 2 elements that we've looked at with both developers and occupiers is kind of the design and construction stage. So kind of the whole sort of carbon assessment in respect of embodied carbon within the construction materials, but also then the in operation sort of agenda in respect of reducing operational energy as well, in respect of putting PVs on the roof or doing some air source heat pumps, battery charging and storage. So it's very much on the agenda for developers. I think they realise that for the investment purposes, that's what they need to do as well. So it kind of protects the investment.
Thank you, Richard. We're always very prompt on our webinars, so we are going to wrap it up there. But before we go, two things. Firstly, I want to thank Andrea Ferranti, our head of research, for this presentation. I want to then thank our panelists, Richard, Steve, Georgia, Simon and Rob, for taking time out of their day. We greatly appreciate this. And last but not least, to say I wish England good luck in our forthcoming match tonight. So thank you very much for joining our webinar today. Take it easy. Bye.